Welcome back to Conveniently Unspoken, where we unearth the untold stories of history. In this episode, we delve into the enigmatic panics of 1893 and 1907, revealing their profound impact on the United States financial landscape and their role in shaping the birth of the Federal Reserve. The Panic of 1893 struck like a storm, casting a shadow from 1893 to 1897. Triggered by a web of causes, including the collapse of railroad expansion, excessive agricultural production, a gold reserve frenzy, and a wave of bank collapses, this economic hurricane unleashed widespread unemployment, business closures, and societal unrest. Amid this chaos emerged key players. Enter J.P. Morgan, a financial titan who wielded his influence to stabilize the teetering financial realm. As we discussed in previous videos, J.P. Morgan to this point had worked with several of the Rothschild agents sent to America to plant their financial stake in the now prosperous United States. These agents include August Belmont, Jacob Schiff, and Paul Warburg. August Belmont was a prominent financier and diplomat. August Belmont was a key agent of the Rothschild family in the United States during the mid-19th century. He established himself as a powerful figure in American finance and politics, with close ties to the Rothschilds. Belmont played a significant role in financing the Union during the Civil War and furthered Rothschild interests in the country. Jacob Schiff was a partner at the investment banking firm Cohn, Loeb and Company, is often associated with Rothschild interests. Schiff played a pivotal role in shaping financial and economic affairs, including facilitating loans to Japan during the Russo-Japanese War. Paul Warburg was a partner at Cohn, Loeb and Company, had connections to the Rothschild family, and was a strong advocate for banking reform in the United States. He played a significant role in shaping the Federal Reserve System, which was established in 1913. While J.P. Morgan was not a formal agent of the Rothschild family, he had significant financial ties and interactions with them. His banking operations often intersected with Rothschild interests, and his collaboration with other banking elites had implications for the broader financial landscape. During the Panic of 1893, Morgan rallied fellow bankers, orchestrating a monumental loan to replenish the gold reserves and stabilize the storm-tossed ship of the federal government. Meanwhile, Jacob Schiff strategically maneuvered relationships to provide gold to the government, offering a glimmer of hope in the midst of crisis. The aftermath of the Panic of 1893 reverberated with a resounding call for change. Efforts were made to stabilize the banking system and restore confidence in financial institutions. The banking system underwent reforms to enhance its stability and prevent future crises. The National Banking Act of 1893 and the subsequent Gold Standard Act of 1900 were among the legislative measures aimed at addressing monetary and financial issues. The seeds of reform were sown, culminating in the movement towards a central bank that could serve as a financial lighthouse during turbulent times. Yet, it wasn't until the Panic of 1907 that this notion would evolve into reality. Fast forward to the Panic of 1907, known as the 1907 Bankers' Panic, which was a financial earthquake that sent tremors through the U.S. economy. The panic was set in motion by a sharp decline in the stock market. In early 1907, the stock market experienced a downturn due to concerns about the overall health of the economy and the financial stability of certain companies. Augustus Hines and Charles W. Morse, two financiers, attempted to corner the market on the stock of United Copper Company. They used fraudulent and speculative practices to artificially inflate the price of the stock. When their efforts failed, the stock's value plummeted, causing panic and losses for investors. The collapse of United Copper Company's stock triggered a wave of panic and uncertainty in the financial markets. Fearing that their investments were at risk, depositors rushed to withdraw their money from banks, leading to bank runs. These runs resulted in liquidity shortages and put additional strain on the banking system. The bank runs and liquidity shortages spread across the financial sector, affecting various banks and financial institutions. As banks struggled to meet the demand for withdrawals, a crisis of confidence emerged, further exacerbating the panic. In October of 1907, J.P. Morgan published rumors of instability with the Knickerbocker Trust. Following these announcements, the run on Knickerbocker intensified. The next day, After depositors had withdrawn nearly $8 million, it suspended operations. Later that month, Morgan organized a plan to infuse funds into the Knickerbocker Trust in an effort to prevent a wider banking panic. While the trust still failed, Morgan's intervention helped contain the crisis temporarily. He was equally to blame as the orchestrator of the panic as well as its stability. With calculated precision, he rallied a consortium of bankers, acting as a financial bulwark against imminent collapse. Morgan effectively acted as a lender of last resort by providing financial assistance to distressed banks. His interventions aimed to restore confidence in the financial system and prevent further bank runs. Joining the fray was Paul Warburg, a visionary advocate of banking reform. He championed the creation of a central bank, modeled after European counterparts, to shield against future upheavals. As the panic unfolded, Warburg worked closely with Senator Nelson Aldrich to develop a plan to address the crisis. This collaboration led to the Aldrich-Vreeland Act of 1908, which allowed for the issuance of emergency currency by national banks to address financial emergencies. While the act did not create a central bank, it provided a temporary mechanism to address liquidity issues during crises. All roads, of course, lead to the clandestine meeting on Jekyll Island in 1910, as history took an intriguing turn. A symphony of influential minds convened, including Senator Nelson Aldrich, A. Piatt Andrew, Henry P. Davison, Benjamin Strong Jr., Frank A. Vanderlip, and Paul Warburg. Together, they wove the tapestry of banking reform and the inception of a central banking system, an embryo that would birth the Federal Reserve. A cast of proponents and opponents danced on this stage. Visionaries like Paul Warburg championed the Federal Reserve, envisioning it as a guardian of financial stability and a haven in times of turmoil. Yet, opponents harbored concerns, fearing the concentration of power and potential government intrusion into monetary affairs. Amid the intrigue, one question echoes: did the Rothschild family have a role in this intricate symphony? While whispers of their direct involvement linger, their indirect involvement through their agents has been well documented. Therein, the Federal Reserve System was a culmination of American endeavors supported by European interests to create a central banking system in the United States once and for all. In the grand scheme, the panics of 1893 and 1907 ignited a beacon of reform, illuminating the path towards the creation of the Federal Reserve System in 1913. Designed as a fortress of financial stability, the Federal Reserve was endowed with the authority to steer through financial storms, regulate the money flow, and safeguard economic equilibrium. Stay tuned as we unravel more of these cryptic threads in history, revealing the conveniently unspoken narratives that have shaped our world. On the next episode, we will continue to dive deeper into the meeting on Jekyll Island, as well as the players for and against the creation of the Federal Reserve. Don't forget to like, subscribe, and hit the notification bell to embark on this journey of discovery. Remember, the truth may be conveniently unspoken, but it's worth seeking.